Hey guys, Boris Schlossberg from BKT. Good to be with you again. We have had so much interest and demand in my scalping strategy that I'm going to devote one more video to the whole idea because I want to review the basics, try to use annotation on YouTube to hopefully give you guys the clues, point you to all the other videos that I've done, and basically show you some of the new developments that I did this week. So bottom line, I want to review the scalping strategy first and foremost. The key question is, what do we do? We look at a 5-minute chart and we try to sell tops, buy bottoms using statistical evidence. And for our statistical evidence, we're using Bollinger Bands, 2 standard deviations, and we're looking for 2 candles outside of the Bollinger Band, the second standard deviation Bollinger Band. This is first standard deviation, this is second standard deviation. 2 candles outside of it where the close must end outside if you're on the sell side, or outside if you're on the buy side over here. One key exemption that we always do is that we never fade round numbers or 50 handle. Let me just show you. So for example, even if I get the setup but it's at the 36 handle, I will not be shorting this. I will wait until prices move through the 36 handle. Similarly, even if I get the signal but I have it at around 35.50, like right around here, again, I will not be buying before the 50 zone. Basically, I never try to short if the stuff is falling down from the 00 to the 80 zone, and if the stuff is rising from the 00 to the 20 zone. Those are the zones that I call the hot zones, and for those of you who are interested in my 00 setup, you can take a look at that. I'll point you to some directions on the 00 setup as well. But the reason why we don't do this is because stops bunch up at these numbers, usually at the round numbers and at the 50 figure. And what you're really looking to do, what this whole strategy is all about, is about pocketing all of that vacuum that happens. Once the stops get hit, you get this big run up, and then all of the exhaustion occurs, and you get a little bit of retrace. And we're buying the retrace. We're also trying to buy the retrace on the other side. So that's why, even if I'm getting the setup on the Bollinger Band side, I do not take it unless I am outside of these key zones, because that's the key thing that you want to use. Lastly, this is not a strategy. What I mean by that is, this is not some mindless black box thing you can program. I guarantee you, anybody who programs this is going to lose money. No trading strategy ever works in a programmatic way because it always requires a degree of discretion. This is simply a framework for operation. Each one of you is going to have to make their own adjustments, learning from the market, adapting to how you trade in order to make this thing successful. So anybody who tells me, oh, I followed your rules to the T, I didn't make money, there are no rules to the T. Even the rules that I'm giving you right now, I sometimes break left or right. These are general framework rules on which I operate, but I do not always follow them exactly. You have to look at the context of the market in order to make your decision. Bottom line is, if you're trying to create an ATM, if you're trying to create a mindless robot that's going to make you a millionaire, good luck. I've never seen anyone work it. I've seen hundreds, thousands of systems. I've never seen one single system make money. So I warn you ahead of time, do not take any of this stuff literally. It is a framework for you to operate. Now, having said this, I kind of want to just show you interesting variation. I mean, this, as you can see over here, you see how I'm ignoring the 3600, and I do short and I succeed in the euro dollar around 36.20 on the upside. Similarly over here, I'm ignoring the 50 zone. Well, actually, no, I'm sorry. In this chart over here, I buy right. I buy underneath the 50, and it works well. Here, I'm buying in the 30 zone. I get stopped out, and on the next one, I make money. Another very important aspect of this setup that everybody needs to understand, I'm going to show you exactly why, is that it's going to fail just as much as it's going to succeed quite a lot. In other words, you're making a probative attempt. You're probing the market to see if you have an actual bottom in place. And it's very, very important that you're trading with tight stops, that if you're getting stopped out, you give it another attempt at 10 points lower, because typically you're close. And what happens with a lot of people is if they get stopped out, they simply just freak out and walk away, when in fact the next trade is actually usually the profitable trade. Having said this though, if I have 2 consecutive trades as prices are cratering or prices are rising, they stop me out, I will walk away from the setup and wait maybe half an hour for prices to reformulate themselves, because clearly something is going on in the market that's outside of the norm. What are we trading here? We're trading basically statistical norm. We're trading reversion to the mean. Most of the time reversion to the mean works, but there are exceptional times in the market when it doesn't. And it's imperative that you understand that and walk away from the market when reversion to the mean does not work. But I will show you how much of a grind this really is. This isn't the situation where you're banking money, banking money, banking money, banking money. It's a situation where you're banking money, losing, banking money, losing, banking money. It's a consistent workshop. It is not anything that gives you just easy, free cash. Having said this, I want to show you just a couple of interesting trades, because there's a perfect example of where this is a statistical trade, not a fundamental one. This is Timmy Geithner coming out with his dollar comments, right? Dollar negative comments, where he was saying that he thought the Chinese had a viable idea. Now, on a fundamental basis, I was very bullish euros based off of this situation. But on a microsecond, market reactive basis, I knew this was going to be a corrective phase. As you can see over here, now I did not know that he was going to come back 5, 10, 15 minutes later and change his mind. But even before he even came back, I knew that having it blown through the 36 handle into the 20 zone, there was going to be a real possibility there was going to be some retrace. Got short here and obviously made money. And of course, later on, he made his comments and it reversed itself. But had it not reversed itself and it would have continued higher, it still would have been a good trade, because it was a statistical trade, not a fundamental one. So you could have a completely opposite position fundamentally, but for this particular scalping strategy, take the exact opposite position of your situation. I want to show you the same situation, fading Timmy Geithner on the yen. Let me show you. Where is this? Okay, here's another one. Perfect example. This is the inverse, of course, of this. We're breaking, of course, all of the Bollinger Bands over here. We broke below the 97 handle. Here's a perfect example where, again, you have to be flexible. In times of huge market volatility, you don't quite perfectly get, the full, let's say, buy at 90. This broke the 9,700 zone, right? It broke it, and it kind of popped back up, and I couldn't quite get in at around 96.80. So I got in at around 96.90. It was good enough for me, because I knew that the power of the move was such that it was going to have huge upside potential, and you can't always get the perfect print on the price. So bottom line is, when these things happen, you have to be very quick and very reactive in order to be able to achieve your goals. I just want to show you finally, again, the continuation of my equity curve, because I think it's important for everybody to understand how the strategy is working. So pretty much the equity curve for this week was like right around here. And as you can, it starts right around here where my pointer is, and this is the equity curve. We're still having a very nice growth, but as you can see, you're spending quite a lot of time just making money, giving it back, making money, giving it back, until you get big bursts where you're catching a good run. And then the key thing is not to give it back once you've made new highs. You see how controlled and disciplined I am? Okay, I may not be making money, but I'm not giving money back. I'm basically making one winner, one loser, one winner, one loser, until I get a good groove of the market, until I get a good risk aversion situation, and I'm timing my trades better, and hopefully take myself to new highs. This is trading in a real sense. It is not this perfect, nice, easy line where every single trade just simply adds to your wealth. It's fighting every inch of the way not to give your money back. This is as important as this. And that's kind of what I wanted to share with you as my final thoughts on how to properly scalp in a fast and furious market. This is Boris Schlossberg wishing you the best of luck. I'll talk to you next week.